When the market goes sideways, what smart investors do behind the scenes. Introduction. Calm waves don't mean the sea is at peace. My friend, this is a story rarely told. No crashes. No big rallies. Just a market drifting sideways in familiar price ranges. No drama. No excitement. And that's exactly why this is the most dangerous phase. Not dangerous because the market is crashing, but because you start losing patience. You start giving up. Or worse, you act just to escape the feeling of doing nothing. Sounds familiar? You open your trading screen. Stocks inch up, then dip slightly, then go green again. You're not sure whether to celebrate or worry. It's called a sideways market, but really, it's slowly burning away your focus. The big question is, what are smart investors doing when the market goes sideways? They're restructuring their mindset, streamlining their portfolio, watching where the money's flowing, and quietly preparing for the next uptrend, while others are tired and backing out. Just like martial arts, the moment of stillness is when the strong are training their inner power. A sideways market is a hibernation phase before a new trend emerges. Those who prepare in silence now will leap ahead when the time comes. So, what are you doing right now? Just waiting? Chasing random hype stocks or junk coins? Or do you already have a plan in motion? If not, then you might be missing a huge opportunity. Because preparation time is never guaranteed. In this video series, I'll walk you through the mindset needed when the market lacks clear direction. How to spot and filter promising stocks. How to build your watch list and simulate your portfolio. A capital allocation plan to be ready for the right moment. And more importantly, how you can turn this seemingly dead phase into a launch pad for future success. If you've ever thought, there's nothing to do in this market, then you're mistaken. The winner isn't the one who buys at the perfect bottom. It's the one who prepares before the bottom appears. And now, you, the one watching this video, are standing at a crossroads. Float aimlessly with the market like most people, or become the kind of investor who moves with strategy and intention. If you choose the second path, then walk with me. Right now, we're stepping into part 1. The right mindset for a sideways market, time to train your financial inner strength. Don't forget to subscribe to Bold Steps Forward. If you truly want to level up your investing mindset with us, where bold moves begin with the quietest preparation. Part 1. Mindset during a sideways market, training your financial inner strength. When the market doesn't go up or down, just drifts within a narrow range, most investors fall into 2 traps: boredom and reckless action. They sell good stocks out of impatience. They buy junk stocks for fun. They go back to quick trades because they can't handle the stillness. But that only drains their portfolio and cracks their mental resilience. Smart investors are different. They understand a sideways market is when mental discipline is forged the most. And here are 3 core mindset principles you must master to avoid getting lost when the market shows no clear trend. 1. Don't chase the wave, seek the truth. During sideways markets, people often ask, what can I buy now to quickly make 10 to 15%? But real investors ask, Which businesses are quietly building strength for the next 2 to 3 years? Sideways markets distort the reflection of true value. Some stocks are forgotten despite steady growth. Others stay overpriced even as fundamentals deteriorate. This is when smart investors return to fundamentals. Is gross profit improving or declining? Are margins stable or volatile? Is the debt-to-equity ratio spiking? Is cash flow from operations positive or negative? The truth behind a business is your compass, not the fleeting waves on the surface. 2. Don't trade, observe institutional behavior. A sideways market is where big money starts sparring. You might see a stock goes slightly green, then gets pushed down within the day. Leading sectors surge briefly, then stall. Penny stocks shoot up and crash just as fast. These aren't random, they're psychological stress tests on the crowd. Smart investors don't jump into the noise. They observe which stocks are quietly accumulated over multiple sessions. Which ones hold their base levels despite volatility? Which stocks show declining volume while the business keeps growing? They don't trade out of boredom. They act only when the odds are optimal. Because they know a few well-timed moves beat 10 impulsive trades in a noisy market. 3. Don't ask, when will it rise? Ask, am I ready? Most investors just wait for a rebound or a breakout. But the market doesn't care what you're waiting for. It will move when the majority have given up. Smart investors don't ask, when will the market rise? They ask themselves, have I identified 5 stocks with strong cash inflow? Do I have a sensible capital allocation plan? Do I know when to go big and when to just observe? They are not passive. They are prepared. And that preparation is what sets them apart. End of part 1. The mental shift. A sideways market doesn't destroy anyone. Lack of direction and patience, that's what drains portfolios. So remember, this is a time to observe, not to act. A time to assess strength, not chase hype. A time to build discipline, refine your focus, and elevate your mindset. In the next part, we'll dive into a practical strategy. How to read money flows and spot stocks being quietly accumulated by smart money. This is a survival skill if you want to stay ahead of the market. Part 2. Flow tracking strategy, spotting quiet accumulation before the breakout. During a sideways market phase, price movement may seem stagnant, but capital still shifts quietly beneath the surface. That's why smart investors don't rest. They monitor big money flows like a patient predator watching its prey. Below are 3 practical strategies to help you detect stocks under silent accumulation before the market catches on. 1. Monitor unusual liquidity and volume. The first sign of quiet accumulation is abnormal trading volume, not necessarily price spikes. What to look for? Rising volume without strong price increases indicates accumulation without revealing the full position. Price remains stable despite overall market pullback, suggests strong underlying support. Volume surges during sharp declines, but the price holds its base, indicates purposeful buying. This is not the time to buy immediately. Instead, add these stocks to your watch list and observe closely over the next few sessions. 2. Identify strong accumulation bases. Stocks under accumulation typically don't move erratically. Instead, they trade within narrow ranges, form solid bases, and shake off weak holders. Signs of a strong base. Narrowing price range over time. Decreasing volume, speculative money is leaving. Low volume, supply tests, slight dips followed by quick recoveries. The longer the accumulation base, the stronger it becomes. And when big money decides to trigger a breakout, these stocks tend to surge with sustainability, not just another bull trap. 3. Combine flow analysis with institutional data. Smart investors don't just read charts. They interpret institutional money flow through data. Sources to watch. Net buying/selling trends of foreign investors and proprietary traders. Stocks added to institutional portfolios or major ETFs. Quarterly financial reports with cash flow surprises. If a stock meets the following: quiet net buying by institutions over 4 to 6 consecutive sessions. Stable profit growth and positive cash flow. Holding a solid base during a sideways market? That's not coincidence. It could be preparation for a breakout phase. Part 2 Summary: Precise action instead of random moves. Just because the market seems quiet doesn't mean there's nothing to do. In fact, this is when sharp investors find hidden opportunities. Remember, track unusual liquidity, not just short-term price swings. Prioritize stocks with strong accumulation bases. Combine institutional money flow with fundamental data. In the next part, we'll dive into the crucial step 3. How to build a smart capital allocation strategy. No bottom fishing, no FOMO, just precise timing to catch the real wave. Part 3. Smart capital allocation. No FOMO, no bottom fishing, just timely wave catching. During a sideways market phase, many investors fall into two extremes. Either they go into full hibernation, or they keep trying to catch the bottom. Both are dangerous. Smart investors take a different route. They allocate capital step by step, based on signals, not emotions. 1. Don't catch the bottom, only catch confirmation waves. First rule: stop trying to catch the bottom. Sideways markets are noisy zones. Every dip isn't a buying opportunity. It could be just another bull trap. Instead, wait for clear confirmation signals. The stock breaks out of its base with volume above the 20-day average. It closes above the nearest resistance zone, a technical buy signal. Institutional money continues net buying, indicates backing behind the scenes. This is when to execute your first entry, a test position of 10 to 20%. 2. Split your entries. Ride the wave, not the emotion. Never go all in at once. A sideways market is perfect for deploying capital across short-term and long-term waves. Suggested strategy. Entry 1. Test position. After breakout from the accumulation base. Entry 2, scale in, if the stock rises another 5 to 7% with sustained volume. Entry 3, hold or trim, when the stock hits resistance or shows signs of weakening. This helps you reduce risk if the signal turns out to be false. Maximize profits if the trend confirms itself. 3. Prioritize stocks with a story, and attractive valuation. Don't just look at the chart. Focus on stocks with unique narratives, new products, market expansion, M&A, restructuring, rising profits without matching price movement, valuation below industry average. In sideways markets, money flows toward clear future expectations. Often, under-the-radar stocks with a solid story are accumulated first and break out early. 4. Maintain a strong cash position. Be ready for the big opportunity. Remember, this is not yet a true uptrend phase. So keep 40 to 60% cash in your portfolio to avoid being trapped if the market suddenly drops. Have dry powder ready for unexpected strong buy signals. Stay mentally proactive, not reactive or emotional. Cash doesn't make you miss opportunities, it helps you seize the right ones. Part 3 Summary: How to invest properly in a sideways market. Don't all in. Don't bottom fish. Don't FOMO. Act like someone who understands the rhythm of the market. Buy after confirmation, not based on emotion. Split your entries. Follow the flow of money. Pick stocks with a story and undervaluation. Hold cash to stay in control, not caught off guard. In the final part, we'll wrap it all up with the big picture. A sideways market is not dead time. It's the moment when smart investors lay the foundation for big future gains. Final part: Not a time to sleep. This is the time to rise. Dear friend, a sideways market is a test. It's not as brutal as a downtrend, nor as thrilling as an uptrend, but it's a phase that filters people out. Only those who understand its nature, are patient enough, and know how to prepare wisely will be the ones to rise most powerfully when the trend returns clearly. You've walked with me through the right mindset in a sideways market, the specific actions to take, how to allocate capital strategically and stay in control, and how to select stocks with a story and breakout potential. Now, it's time to turn knowledge into real, practical power. If you found this video helpful, don't keep it to yourself. Share it with your friends, colleagues, anyone who's struggling through this tiring sideways phase. And if you want to get more videos analyzing real case studies, receive stock watch lists with hidden stories quietly being accumulated. Learn step-by-step how to value stocks, build portfolios, and manage risk like a pro. Subscribe to the channel Bold Steps Forward right now. Because we don't stop at theory. We walk with you until you reap the results. Leave a comment below. I'm ready to act like a smart investor. I read every line and will respond to you personally. Thank you for staying until the very end. See you in the next video, where we'll take even bolder steps on the journey of smart investing. Bold steps forward. Let's move ahead together.